Welcome investors, and thanks for joining us on your Investment Advisor channel, where we decipher the market so you can make actionable investment steps. I'm Jake Ackerman. The deal gets done, Republicans aren't happy, Democrats aren't happy, the American people are happy. A little bit hotter than expected inflation report, not really inflation, but it is inflationary, and the stock market rises. Let's take a look under the hood and find out what's going on this week in the market. Just days to spare, Senate gives final approval to debt ceiling deal, and it's sending it to President Joe Biden's desk. All right, so let's look at that debt ceiling deal. And again, I said in the beginning, Republicans aren't happy, Democrats aren't happy, but the American people, we wanted to get this deal done. I mean, this was ridiculous how long it dragged out, but this is the political world we live in, so we should expect nothing less. The debt ceiling deal keeps spending, the discretionary spending, but cuts it slightly, keeps the tax cuts, and does open up a major pipeline that was 95% completed. So that's going to be a nice deflationary pressure, most likely going forward. And we already are seeing the ramifications from this pipeline opening in the futures crude oil prices. We've seen them on the decline. The Republicans got a little bit what they wanted, Democrats got a little bit they wanted, and now we can move on with our lives and don't have to hear about this negotiation, the political jockeying back and forth, which is just a fantastic thing. Moving on to the inflation pressures, let's take a look at some information for you. This was last week. This was the PCE, personal consumer expenditures, came in a little bit hotter than expected. Now let's take a look at some of this week's data. And this week, meaning today, a really hot jobs number came in, nearly double the expectations. It came in at a whopping 339,000 new jobs. 190 was the expectation. And that's, folks, that's inflationary. Fed has been talking about the jobs need to come down, and it came in hot. We had another couple things happen this week. We had a Fed speaker basically say, hey, they're comfortable, a couple of Fed speakers, they're comfortable with not raising interest rates in June and letting what they've done to monetary policy play out at least for maybe another month. Well, does the PCE and the jobs number throw a wrench into that dynamic? And that's definitely a possibility. If we do, on the 13th, which is the first day that the Fed meet, they meet the 13th and the 14th of June, where they're going to make their next rate decision. On the 13th, we get another CPI data release. That is going to absolutely play a calculation into whether the Fed is going to raise interest rates on that June meeting, or they're going to wait until July. And we've had a few hot numbers coming in. Let's take a look at what the bond market is telling us. All right, so that's I got up here the 2-year Treasury, and guess what? It's on its way back up. So you have the stock market rising, you have the bond market that is. It was for temporarily saying, hey, we're not going to do another interest rate hike because of the Fed speakers. And then we have some more hot data and probably another hot CPI report. So the bond market is starting to tell us, hey, that we very well could do this June rate hike. Or we don't do a June rate hike, but we talk about the next meeting rate hike. And the market's already going to start pricing then that in. I mean, the bond market looks like it already is. The bond market's telling us that we're going to get one more this year, maybe even two, but it's going to be data dependent, and the data is telling us that right now inflation's still hot. So what does the Fed do? Well, let's see what the stock market's doing real fast. Stock market is on its parabolic move. That big resistance of 4,200 has been broken. And the next stop is that 4,300. And boy, what a great place to take some profits that if you're in. And if you're sitting on the sidelines, the train has left the stations. Might not be a bad idea for you to just sit there and sit tight for a little bit and see how this plays out. But there's still some opportunities out there. I'm just showing you the S&P 500. Some other sectors can very well present you some opportunities, and those are the lagging sectors. If you take a look at maybe some healthcare, utilities, and maybe even some energy stocks, that might be an opportunity if you so choose and you have that risk tolerance in your portfolio. So next week, we're rallying into this major price resistance area on the overall broader market. That gives us an opportunity for the people that we're in, maybe sit on the sidelines and squeeze out some profits, because the following week, June 13th and 14th, the Fed is going to make their rate decision. And as a money manager of a lot of my clients' accounts, if a market's rallying to a big news event, not really looking for buying opportunities. We're looking for the opposite, maybe sitting on our hands or taking some profits or doing a little bit of selling into this. And again, some strength gives us a really nice opportunity to take a little bit off the table here. So hey, stay tuned for next week. We'll discuss what happened that week and maybe get some more insight of what the Fed might do in that June 13th and 14th meeting. Expertise you deserve, experience you can count on. Jake Ackerman.